There is a phrase you hear on financial television, in press releases, and in the breathless analysis of market gurus. It's presented as an unalloyed good, a celebration, a moment when a company signals its ultimate confidence in its own future. The phrase is share repurchase program, or more commonly, the stock buyback. When a company you own announces it's buying back billions of dollars of its own stock, the conventional wisdom tells you to cheer. The stock price often ticks up. The analysts praise the management team for returning capital to shareholders. It feels like a vote of confidence backed by the most sincere thing in the world: cold, hard cash. But this common, celebrated corporate action can be a weapon of mass value destruction, a magic trick that makes your wealth disappear in plain sight. It can be a trap, set not by malice, but by ignorance, ego, and misaligned incentives. Warren Buffett, the master of capital allocation, understands this on a level that few others do. He knows that a stock buyback is not an act of financial wizardry. It is a simple transaction, and like any transaction, it can be brilliant, or it can be breathtakingly stupid. The difference between the two is the single most important variable in long-term investing: the price paid. A company buying back its stock when it is cheap, when it is trading for less than the underlying business is worth, is an act that creates immense value for the shareholders who remain. It is like owning a slice of a pizza, and the pizzeria owner uses the day's profits to buy back a few slices from other patrons at half price and throws them away, making your personal slice bigger and more valuable without you lifting a finger. But a company buying back its stock when it is expensive, when the market is euphoric and the price is sky high, is an act of corporate self-immolation. It destroys your value from the inside out. It's like that same pizzeria owner, flush with cash from a busy night, buying back slices from patrons at double the menu price. Your slice doesn't get any bigger in a meaningful way. The business is just now much, much poorer. The mistake the average investor makes is cheering for the announcement, for the action itself, without ever asking the critical question, at what price? They celebrate the transaction without knowing if they are the beneficiary or the victim. Over the next hour, we are going to dismantle this misconception. We will give you the mental model to critically evaluate every capital allocation decision you see. You will learn to separate management teams that are genuinely building long-term value from those who are just playing games with corporate finance to boost their own bonuses. This is not just an academic exercise. This is the key to superior stock picking. It is the foundation of a robust investment strategy that protects you from the subtle traps of Wall Street and aligns your portfolio with the principles of true shareholder value. This is the dividing line between the retail investor who gets washed out every market cycle and the sophisticated owner who achieves lasting financial freedom. To truly understand the power and the peril of stock buybacks, we must first rewire our brains. We must stop thinking like stock traders and start thinking like business owners. This is the bedrock of all value investing, the foundational principle upon which Warren Buffett built his entire empire. A share of stock is not a flickering symbol on a screen, a lottery ticket whose value is determined by market sentiment. It is a fractional ownership stake in a real, living, breathing business. When you internalize this, everything about investing changes, especially your view on capital allocation. The greatest story to illustrate this owner's mindset is not about a famous blue-chip stock, but about a struggling farm equipment manufacturer in Nebraska, the Dempster Mill Manufacturing Company. In 1956, Buffett was running his early partnership, a small pool of capital from family and friends. He was hunting for bargains, for companies the market had misunderstood and undervalued. He found Dempster. On the surface, it was a mediocre business. It made windmills and farm implements, a tough, low-margin industry. But Buffett did the due diligence that others wouldn't. He looked past the stock price and into the business itself. He read the balance sheet like a treasure map and discovered a secret. The company was trading at a massive discount to its liquidation value. In simple terms, if you shut the company down, sold off all its inventory, its equipment, and its real estate, the cash you'd get would be far more than the total value of all its stock on the market. Specifically, the stock was trading around $18 per share, but Buffett calculated its net working capital alone, The easily sellable stuff like inventory and receivables minus its debts was worth over $72 per share. He was buying dollars for 25 cents, so he started buying. He didn't just buy a few shares, he acted like an owner trying to acquire a business. Over several years, his partnerships quietly accumulated a controlling stake in the company. By 1961, he had control. And this is where the lesson on stock buybacks becomes intensely personal and powerful. Buffett was now, for all intents and purposes, the business owner. He sat on the board. He saw the company not from Wall Street, but from the inside. He saw the bloated inventories and the inefficient operations. He installed a sharp, disciplined manager named Harry Bottle to clean things up. Bottle was ruthless in his efficiency. He slashed costs, sold off excess inventory, and turned stagnant assets into cash. Suddenly, Dempster Mill, this sleepy, mediocre company, was sitting on a mountain of cash. What would the typical CEO do with that cash? They might try a foolish acquisition. They might invest in speculative new product lines. They might just let it sit there, earning a pittance in a bank account, a testament to their indecisiveness. Buffett, the owner, saw a golden opportunity. He knew the business was worth at least $72 per share. But the stock was still languishing on the public market at around $30 per share. The market still didn't get it. So what did he do? He had the company use its own newfound cash to buy its own shares from other unenlightened shareholders. This was a stock buyback, but not the kind you read about in a press release. This was a calculated, opportunistic move by an owner to increase his stake in an undervalued asset. The company made a tender offer, offering to buy shares from anyone willing to sell them at a price far above the market, quote, but still far below the true intrinsic value. Many shareholders, seeing the stock jump from its sleepy price, were thrilled to sell. They took the quick profit, thinking they'd won. They had no idea they were selling their share of a $72 pile of assets for $30 or $40. For every share the company bought back and retired, Buffett's own percentage ownership of Dempster went up. The value of the company wasn't changing, but his claim on that value was becoming more and more concentrated. He was using the business's own money to consolidate his ownership at a ridiculously cheap price. Within 2 years, Buffett's partnerships had realized a massive gain. He eventually sold the cleaned-up, more efficient business to another company for a handsome profit. The Dempster saga is the foundational anecdote because it strips the stock buyback of all its corporate jargon. It reveals it for what it is: a business owner deciding that the best possible investment in the world is to buy a larger piece of his own business, but only when the price is a bargain. This owner's mindset is so effective because it serves as a powerful antidote to a host of psychological biases that plague the average investor. The most relevant here are the endowment effect and the framing effect. The endowment effect, first identified by psychologists like Daniel Kahneman and Richard Thaler, is our tendency to overvalue something simply because we own it. If you give a person a coffee mug and then offer to buy it back, they will typically demand a much higher price than what they would have been willing to pay for it just a moment before. Ownership creates an irrational emotional attachment. For investors, this means once they own a stock, say at $100, they become attached to that price. Their ego gets tied up in it. If the company announces a buyback at $105, it validates their ownership. It feels good. They don't stop to ask if the business is actually worth $150, which would make the buyback a brilliant move, or if it's only worth $70, which would make the buyback a disastrous one. They are anchored to their own ownership in the current price, not the underlying value. The framing effect is even more insidious. How a choice is presented to us dramatically affects the decision we make, even if the underlying facts are identical. Investment bankers and corporate communications departments are masters of framing. They frame a stock buyback as returning capital to shareholders. This sounds positive, generous, and shareholder-friendly, and who wouldn't want capital returned to them? But it's a misleading frame. A more accurate, though less appealing frame would be, we, the management, are taking a large portion of our collective owners' cash and using it to buy out some of our fellow owners. The wisdom of this transaction depends entirely on the price we pay. If we overpay, we are enriching the selling shareholders at the expense of the remaining shareholders. That doesn't sound nearly as good in a press release, but it is the economic reality. Buffett, through his owner's mindset, sidesteps both of these traps. He feels no emotional attachment to a market price. He only cares about the gap between that price and the business's intrinsic value. He is immune to the corporate framing because he doesn't see himself as a passive shareholder receiving a gift. He sees himself as the owner, evaluating a potential transaction proposed by his managers. The question is never, is a buyback good? The question is always, is this purchase at this price the single best use of our company's capital right now? This mental shift is the entire game. So how can you, as an investor seeking financial literacy and better portfolio growth, adopt this mental model? Here is the blueprint, the step-by-step process to transform yourself from a stock renter into a business owner. Step 1. Reframe your vocabulary. Stop saying my stock went up or my stock went down. Start saying the market's quoted price for my share of the business went up, or the market offered to sell me more of this business at a lower price today. This isn't just semantics. It's a deep psychological shift that creates distance between your emotions and the market's manic-depressive mood swings. You are the proprietor, and the stock market is just a strange man on the street yelling different prices at you all day. You are under no obligation to act on his yells. Step 2. Read the annual report like a letter from your business partner. Most retail investors never read the 10K. They get their information from news headlines and analyst reports. This is like owning a restaurant and only learning about its performance by reading Yelp reviews. You must go to the source. The CEO's letter to shareholders is your partner telling you how he ran your business for the past year. Does he talk with clarity about business operations, competitive advantages, and capital allocation? Or does he fill the pages with corporate jargon, buzzwords, and excuses? Buffett says he can typically judge a management team just by reading their letters. Look for honesty about mistakes and a clear, rational framework for how they deploy your cash. Step 3. Calculate what Buffett calls owner earnings. This is the true cash flow of the business that belongs to you, the owner. The formula is simple. Start with net income. Add back non-cash charges like depreciation and amortization, and then subtract the average amount of capital expenditures the business needs to maintain its competitive position and unit volume. This isn't about getting a perfect number. It's about understanding the real cash the business generates year after year. Is it growing? Is it consistent? This number, not the reported earnings per share, is the engine of value. Step 4. When a buyback is announced, perform the owner's test. Ask yourself 2 questions. First, based on my understanding of the business and its owner earnings, is the stock price today significantly below what I believe a rational private owner would pay for the entire company? You don't need a complex model, just a range of reasonableness. If the answer is yes, the buyback is likely creating value. Second, what are the other potential uses for this capital, and is this buyback truly the best one? We will explore this hierarchy of capital allocation in greater detail later, but for now, just ask if there are obvious high-return projects the company is foregoing to buy back its stock. If a fast-growing tech company is buying back stock instead of investing in crucial R&D, that's a massive red flag. By following these 4 steps, you move from being a passive passenger to an active, engaged owner. You are no longer swayed by the headlines. You are performing your own due diligence, building a foundation for truly long-term investing. The tragedy is that 99% of market participants live in a completely different universe. They follow the antithesis of the owner's mindset, what we can call the path of the 99%. This path is paved with price charts, momentum indicators, and the endless chatter of financial news. The person on this path sees a stock as a purely symbolic entity. Their entire investment strategy is based on predicting the short-term emotional reactions of other people. When a buyback is announced, their thought process is simple and dangerously flawed. A buyback means the company is buying shares. More buying means the price will go up. I should buy too. They cheer the announcement because they anticipate a short-term price pop, a sugar high for their portfolio. They give zero thought to the underlying transfer of value. They don't know or care if the company is buying back shares at 5 times what they are worth. In fact, for the momentum-focused trader, a buyback at an all-time high is the best possible news. It signals ultimate confidence and seems to justify the stratospheric valuation. It becomes a self-reinforcing delusion. We saw this play out with countless technology companies in the late 1990s. Companies with flimsy business models and astronomical stock prices, flush with cash from their IPOs, announced massive share repurchase programs. Wall Street went wild. Investors, caught in the mania, saw these buybacks as proof that the good times would never end. A company like Cisco Systems, a great business in its own right, spent billions buying back its own stock at the absolute peak of the dot-com bubble. Management was cheered for it. They were seen as visionaries. But they were paying prices for their own stock that were divorced from any rational calculation of future cash flow. They were taking shareholder money, real tangible cash, and setting it on fire in exchange for their own ridiculously overpriced paper. When the bubble burst, those billions of dollars were gone, forever. The stock price collapsed, and the shareholders who held on for the long term were left with a massively depleted company. The capital that could have been used to innovate, to make smart acquisitions during the downturn, or simply been paid out as a dividend, had been vaporized. This is the path of the 99%, cheering the action, ignoring the valuation, and ultimately paying the price. The direct financial connection between an owner's mindset buyback and a trader's mindset buyback is stark and can be illustrated with simple arithmetic. Let's imagine a business, Owner Corp. It earns a steady $10 million a year in owner earnings. It has 1 million shares outstanding, so its earnings per share is $10. A rational private owner might value this stable business at, say, 10 times earnings, or $100 million, which translates to $100 per share. Now, let's create 2 scenarios. In scenario A, the market is pessimistic. For some reason, it's worried about the industry, and the stock of Owner Corp is trading at only $50 per share, valuing the whole company at a mere $50 million. The management, thinking like owners, sees a fantastic bargain. They take 1 year's entire earnings, $10 million, and use it to buy back their own stock on the open market. At $50 a share, they can repurchase 200,000 shares. These shares are then retired. The company now has only 800,000 shares outstanding. The next year, the business still earns $10 million. But what is the new earnings per share? It's $10 million divided by 800,000 shares, which equals $12.50. The EPS has grown by 25% without the business doing anything different operationally. Every remaining shareholder now owns a 25% larger piece of the same profitable pie. Their intrinsic value per share has shot up. This is the magic of an accretive, value-creating stock buyback. Now consider scenario B. The market is euphoric. Tech is hot, and analysts are slapping a huge multiple on Owner Corp. The stock is trading at $200 per share, valuing the company at $200 million, double its rational intrinsic value. Management, feeling the pressure from Wall Street to do something with its cash and wanting to goose the stock price even higher, announces a $10 million buyback. At $200 a share, they can only repurchase 50,000 shares. After the buyback, the company has 950,000 shares outstanding. The next year, it still earns $10 million. The new earnings per share is $10 million divided by 950,000 shares, which is approximately $10.53. The EPS barely budged, but the real damage is hidden. The company spent $10 million of its owners' cash to buy 50,000 shares that were intrinsically worth only $100 each, or $5 million in total. They literally took $10 million from the company bank account and lit $5 million of it on fire. The continuing shareholders are now owners of a business that is $10 million poorer, but their claim on future earnings has barely increased. This is a value-destructive buyback, a silent theft of shareholder value, all done under the guise of being shareholder-friendly. This simple math is the core of this entire thesis. Understanding it is a cornerstone of financial education and the first step toward building real, long-term wealth. Once you've adopted the owner's mindset, the next logical step is to have a reliable method for judging the price part of the equation. A buyback is only good if the stock is cheap. But what is cheap? How do we determine that? This brings us to the second great pillar of our analysis, the litmus test of price versus intrinsic value. Intrinsic value is one of the most important concepts in all of finance, yet it is widely misunderstood. It is the discounted value of the cash that can be taken out of a business during its remaining life. In simpler terms, it's what a rational business person would pay for the entire company if they were to buy it for cash. The key thing to remember is that intrinsic value is an estimate. It is not a single, precise number. But even a fuzzy estimate of the right thing is infinitely more valuable than a precise measurement of the wrong thing, like last quarter's earnings or an analyst's price target. The market price is what a stock is selling for. Intrinsic value is what it is actually worth. A great investment opportunity and a great stock buyback opportunity exists when the market price is significantly below the intrinsic value. No story illustrates this concept better than Warren Buffett's investment in the Washington Post Company in 1973. At the time, the market was in a funk. It was a period of gloom and pessimism. The Washington Post Company, which owned the iconic newspaper, Newsweek magazine, and several highly profitable television stations, was being valued by the stock market at a total of about $80 million. Buffett, doing his homework, looked past the stock price and analyzed the individual businesses within the company. He knew a thing or two about newspapers, but he knew even more about the value of network-affiliated television stations. They were virtual monopolies in their markets, printing presses for money. Buffett did a quick, conservative calculation. He estimated that the TV stations alone, if sold off, were worth at least $400 to $500 million. And that was without even counting the newspaper or Newsweek. The entire company was being offered by the market for $80 million, while one part of it was worth 5 times that amount. This was not a borderline case, it was an overwhelming bargain. He began buying shares aggressively, investing over $10 million, a huge sum for him at the time, to acquire a large stake. He was buying dollars of easily ascertainable value for 20 cents. Now, connect this to our thesis. The CEO of the Washington Post Company was the legendary Katharine Graham. She was a brilliant business leader who, along with her family, had a massive ownership stake. She thought like an owner because she was an owner. She also recognized that her company's stock was ridiculously cheap. So over the succeeding years, what did she do with the company's prodigious cash flow? She began to systematically buy back the company's own shares. Every share she bought back at those depressed prices was a home run for the remaining shareholders, including Buffett. She was retiring claims on those $400 million assets for a fraction of their worth. This combination, a brilliant business, a manager with an owner's mindset, and a stock trading at a huge discount to its intrinsic value, is the holy trinity of value investing. The buybacks were not the reason the investment was great, they were the turbocharger. They magnified the fantastic returns that were already inevitable because of the huge gap between price and value. The Washington Post became one of Buffett's most successful investments ever, a testament to this powerful principle. The reason most corporate managers and investors fail this simple litmus test is a powerful cognitive bias known as anchoring. Anchoring is our human tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In finance, the most common anchor is a stock's recent price. Imagine a hot technology stock that soars from $50 to $200 in a year. The $200 price becomes the anchor in everyone's mind. Then, some bad news hits, and the stock falls to $150. To many people, including the company's CEO, the stock now looks cheap. It's on sale for 25% off its peak price. Feeling opportunistic, the board authorizes a massive stock buyback at $150. They are hailed as savvy operators, buying the dip. But the anchor of the $200 peak has blinded them to the reality that based on the business's actual intrinsic value, the stock might only be worth $40. They aren't buying a bargain. They are still paying almost 4 times what the business is truly worth. They have mistaken a decline in price for an attractive valuation. Buffett operates without this anchor. He doesn't care if a stock is down 25% or 90% from its high. His only anchor is his own calculated range of intrinsic value. If a stock falls from 200 to 150, but his calculation of value is 40, he sees it as still wildly expensive. He would only become interested if the price fell below 40 and preferably far below it. This is why he is able to sit on cash for years, patiently waiting, while other investors and CEOs feel the need to constantly be doing something. He is waiting for the market price to break its emotional anchor to recent history and fall to a level that represents a true bargain relative to business reality. CEOs are particularly susceptible to anchoring. Their compensation is often tied to the stock price, and their egos are certainly linked to it. When their stock falls, it feels like a personal failure. Authorizing a buyback is a way to support the stock, to fight back against the market's negative verdict. It's an emotional decision, anchored to a recent high, rather than a rational capital allocation decision anchored to intrinsic value. Understanding this bias is crucial for your own investment strategy, as it allows you to see when a management team is acting out of ego and price memory versus when they are acting out of pure business logic. So how can a retail investor, without a team of analysts, develop a practical method for estimating intrinsic value? You don't need a complex discounted cash flow model that goes out 50 years. You need a tool for thinking, a blueprint for making a reasonable judgment. Let's call it the intrinsic value estimator. Step 1. Find the owner earnings. As we discussed before, this is the starting point. Go to the company's cash flow statement for the last 5 to 10 years. Find the cash flow from operations. Then find capital expenditures. A simple, conservative estimate of owner earnings is cash flow from operations minus capital expenditures. This is often called free cash flow. Calculate this for the last 10 years to see how stable and predictable it is. A business with wildly fluctuating free cash flow is much harder to value than a stable one. Step 2. Project the future, conservatively. Look at the historical growth rate of the free cash flow. If it has grown at 8% per year for a decade, do not assume it will grow at 8% forever. Be a pessimist. What if it only grows at 4%? What if it doesn't grow at all? Create a few simple scenarios. For a solid, mature business, you might project its current free cash flow growing at the rate of inflation, say 3%, for the next 10 years, and then assume it stops growing after that. This is deliberately conservative. Step 3. Apply a sanity check multiple. A quick way to get in the ballpark of value is to use a multiple on the current free cash flow. A common rule of thumb is that a private buyer might pay around 10 to 15 times the current free cash flow for a decent, stable business. If a company is generating $1 billion in free cash flow, a reasonable private market value might be in the range of $10 to $15 billion. You can adjust this based on the quality and growth prospects of the business. A fantastic, growing business might deserve a multiple of 20, while a declining one might only deserve a multiple of 7. Step 4. Compare to the market price. Now look at the company's current market capitalization, share price times number of shares. Is that number significantly lower than your conservative estimate of its value? If your sanity check multiple suggests the business is worth $10 billion and the market is selling it for $5 billion, you have found a potential bargain. This is the margin of safety that value investors demand. If a company in this situation announces a stock buyback, you should be thrilled. They are retiring shares at 50 cents on the dollar. If, however, the market values the company at $25 billion and they announce a buyback, you should be deeply concerned. They are destroying value with your money. This blueprint isn't about finding a single, magic number. It is about building a framework for judgment. It forces you to focus on the business fundamentals and provides a rational basis for evaluating a management team's capital allocation decisions. It is the practical application of due diligence that separates successful long-term investing from mere speculation. The landscape of corporate history is littered with the wreckage of companies that followed the opposite path, the path of the momentum-driven, value-ignorant buyback. This is the antithesis of the Buffett approach. The dynamic is tragically predictable. A company operates in a cyclical industry like semiconductors, housing, or energy. During the boom times, its profits and cash flows explode. Its stock price, fueled by the good news and market euphoria, goes parabolic. The company is now sitting on a mountain of cash, and its stock is at an all-time high. What does the board of directors do? Feeling flush and confident, and egged on by investment bankers who earn fees on these transactions, they announce a multi-billion-dollar share repurchase program. The financial press praises their confidence. Momentum investors pile in, seeing the buyback as another reason the stock can only go higher. The company proceeds to spend its entire cash hoard buying back its own shares at absurdly high valuations, paying 30 or 40 times earnings. Then, inevitably, the cycle turns. Demand for their product slows down. Profits collapse. The stock price plummets by 70 or 80%. The company now finds itself in a precarious position. The cash that would have been a vital lifeline to survive the downturn, to invest in new technology, or to buy out weaker competitors at bargain prices is gone. It was spent at the top, buying back worthless paper. The shareholders who held on have been doubly victimized, first by the cyclical downturn, and second by the management's catastrophic capital allocation at the peak. This isn't a hypothetical scenario. It has happened again and again. Look at the home builders in 2005 and 2006. They were generating record profits and used that cash to buy back their stock at the very peak of the housing bubble. A year later, their businesses collapsed and their stocks were nearly wiped out. Look at energy companies in 2014, when oil was over $100 a barrel. Many spent lavishly on buybacks, only to see oil prices and their stock prices crash shortly thereafter. The 99% path is to extrapolate the recent past into the indefinite future. It mistakes a cyclical peak for a permanent plateau. The intelligent investor, the one focused on intrinsic value, does the opposite. They understand that the best time to buy is when there is blood in the streets, and the best time to be cautious and hoard cash is when everyone else is celebrating. A company's buyback policy is the clearest signal of which mindset is in control of the boardroom. Let's quantify the financial impact of this litmus test with another side-by-side comparison, focusing on the concept of return on investment for the company itself. Think of a stock buyback as an investment the company is making. The return on that investment is the earnings yield of the shares it repurchases. Let's consider Company A and Company B again. Both earn $10 million a year, have 1 million shares, and therefore have earnings per share of $10. The intrinsic value of both businesses is $100 per share. Company A's stock is cheap, trading at $50 per share. When Company A uses $10 million to buy back its stock, it is buying an earnings stream. For every $50 it spends, it retires a share that is earning $10 per year. The earnings yield on this investment is $10 divided by $50, which is a staggering 20%. Company A is making an investment with its cash that yields 20% per year, risk-free. That is a phenomenal use of capital. Now consider Company B, whose stock is expensive, trading at $200 per share. When Company B uses its $10 million for a buyback, it is also buying an earnings stream. But for every $200 it spends, it retires a share that is earning $10 per year. The earnings yield on this investment is $10 divided by $200, which is only 5%. Company B could have likely earned a better return by simply paying off some of its debt or even just holding the cash in high-quality bonds. By buying back its overpriced stock, it chose the lowest returning option available. The financial impact on shareholder value is profound. The management of Company A, by executing a buyback with a 20% earnings yield, has dramatically increased the intrinsic value per share for the remaining owners. The management of Company B, by executing a buyback with a 5% earnings yield, has likely destroyed value because that $10 million in cash, which was a part of the company's intrinsic value, was exchanged for an asset, the repurchased shares, that will generate a subpar return forever. The balance sheet of Company B is now $10 million weaker, with very little to show for it in terms of increased per-share earning power. This analysis of earnings yield is a simple but powerful tool. The next time a company you own announces a buyback, don't just look at the stock price reaction. Do this simple calculation. Take the company's earnings per share and divide it by the current stock price. If that number is high, say above 10%, the buyback is probably a smart move. If it's low, say below 5%, you should be asking some very tough questions about whether the management team is acting in your best interest. This is the kind of critical corporate finance analysis that separates informed investors from the crowd. We have established that a buyback is only wise when the price is below intrinsic value, but this begs a crucial question. Why would smart, highly paid, MBA-educated CEOs so often make the colossally stupid decision to buy back stock at inflated prices? The answer lies in our third pillar, the corrupting influence of agency costs and misaligned incentives. In corporate finance, there is a classic concept called the principal-agent problem. The principals are the owners of the company, the shareholders. The agents are the managers hired to run the company on the owner's behalf, the CEO and the executive team. In a perfect world, the agents would always act in the absolute best interest of the principals. But we don't live in a perfect world. The agents have their own set of interests: higher salary, bigger bonuses, greater prestige, job security, and the thrill of empire building. Often these interests diverge from the shareholders' interest, which is simply to maximize the long-term per-share intrinsic value of the business. Stock buybacks are a major arena where this conflict plays out. The single biggest reason for value-destructive buybacks is the structure of executive compensation. Many CEOs have a large portion of their annual bonus tied to the company's earnings per share, EPS growth. As we have seen, a stock buyback, even a dumb one, is the easiest way to artificially inflate EPS. A company's total earnings can be completely flat, but if it reduces the number of shares outstanding through a buyback, the EPS number magically goes up. The CEO hits his bonus target, collects a multi-million-dollar check, and is praised for creating shareholder value. But the underlying business has not improved one bit. In fact, it is now poorer by the amount of cash it spent on the overpriced shares. The agent has enriched himself directly at the expense of the principals. Stock options are another perverse incentive. If a CEO has a large number of stock options, a buyback can help keep the stock price elevated, ensuring their options remain in the money and valuable. The buyback acts as a price support mechanism, a corporate expenditure designed to protect the personal wealth of the management team. This is a clear-cut case of managers using the owner's money to benefit themselves. To see this principle in its purest form, we can look at a manager who was the absolute opposite of this corrupting influence: Henry Singleton of Teledyne. Singleton was an engineering genius who built Teledyne into a major conglomerate from the 1960s through the 1980s. He was also arguably the greatest capital allocator of all time, even surpassing Buffett in some respects. Singleton understood the principal-agent problem and solved it by being a massive owner himself and by thinking with brutal mathematical logic. His approach to buybacks was revolutionary. When he believed Teledyne's stock was cheap, he would have the company tender for its own shares with ferocious aggression. In one famous tender offer in 1972, He used debt to buy back a staggering 20% of the company's stock. Wall Street was aghast. Analysts thought he was reckless. But Singleton knew he was buying his own business for a fraction of what it was worth. He was right. Conversely, when the market was hot and Teledyne's stock was expensive, he would do the opposite. He would use Teledyne's highly priced stock as a currency to buy other, cheaper companies. He issued shares when they were dear and retired them when they were cheap. This is the absolute pinnacle of rational, owner-oriented capital allocation. He wasn't trying to hit an EPS target or prop up the stock price. He was engaged in a decade-spanning arbitrage, trading his company's paper for real assets and vice versa, always to the benefit of the long-term shareholder. Singleton's career stands in stark contrast to the modern CEO, who is often a short-term steward, managing the quarterly earnings game to maximize their own take-home pay. The psychology behind this destructive behavior goes beyond simple greed. It's also driven by the powerful force of social proof. This is the tendency to assume that the actions of others reflect the correct behavior in a given situation. In the corporate world, this manifests as herd behavior. When a few prominent companies in a sector, say software, announce large stock buyback programs, it creates immense pressure on other software company CEOs to do the same. The board of directors will ask, "Why aren't we doing a buyback? Our competitor is," the investors will ask. The analysts will ask. It becomes the fashionable, accepted thing to do. To resist the trend is to risk looking indecisive or unconfident. So CEOs fall in line, authorizing buybacks not because their stock is a screaming bargain, but because everyone else is doing it. This herd behavior is particularly dangerous at market tops. The euphoria is contagious. When everyone is making money and feeling smart, the pressure to join the party is at its most intense. The few lonely voices urging caution and valuation discipline are drowned out by the roar of the crowd. The CEO who hoards cash during a bull market is often criticized as being unimaginative or too conservative. The CEO who leverages up the balance sheet to buy back stock at an all-time high is hailed as bold and shareholder-friendly. The social incentives are perfectly aligned to encourage the worst possible capital allocation decisions. The principal-agent problem is amplified by this social pressure. The agent, the CEO, wants to be popular. He wants to be seen as a dynamic leader by his peers and by Wall Street. Resisting the buyback fad is socially costly. It's much easier and much better for one's career prospects to just go along with the herd. This is how entire industries can get caught in a wave of value-destructive buybacks, all driven by the simple, primitive human need to conform. To protect yourself from these misaligned incentives, you must become a student of executive behavior. You need a practical blueprint for grading the management team of any company you own or are considering owning. Let's call it the CEO scorecard. It is a crucial part of your investment strategy and due diligence process. First, obtain the company's most recent proxy statement. This document, which most investors ignore, is a goldmine. It contains the compensation discussion and analysis section. This is where the company is legally required to explain in detail how its top executives are paid. Read this section carefully. Is the bonus heavily tied to metrics like earnings per share, EPS, that can be easily manipulated by buybacks? Or is it tied to more durable, harder-to-gain metrics like return on invested capital, ROIC, or growth in intrinsic value per share? Look for alignment. A well-designed compensation plan aligns the CEO's financial interests with the long-term owner's interests. A poorly designed one encourages short-term gains. Second, read at least the last 5 years of the CEO's annual letters to shareholders. You are not reading for the fluffy marketing language. You are looking for evidence of a specific mindset. Does the CEO talk about capital allocation with intelligence and clarity? Does he discuss the company's intrinsic value and the logic behind his buyback decisions? Does he admit mistakes? Or is the letter filled with vague platitudes and corporate jargon? Compare the letters of a company like Berkshire Hathaway or a CEO known for their capital allocation prowess to the company you are analyzing. The difference in clarity and substance is often night and day. Third, track the company's history of share repurchases. This is the most important step. Create a simple spreadsheet. In one column, list the amount of money the company spent on buybacks each quarter for the last 10 years. You can find this in the cash flow statements. In the next column, list the average stock price for that quarter. What you are looking for is a pattern. Is there a clear inverse correlation? Did the company buy back stock most aggressively when the stock price was in the toilet? This is the signature of a brilliant, owner-oriented management team like Henry Singleton's. Or is the pattern the opposite? Did the company spend the most on buybacks when the stock was at or near its all-time highs? This is a massive red flag, the signature of a management team that is either ignorant of valuation or is simply following the herd. This historical analysis is the ultimate truth serum. A CEO can say all the right things in an annual report, but the numbers don't lie. Where they spent the cash tells you everything you need to know about their true CEO mindset. The antithesis of the masterful allocator is the empire builder's CEO. This is a common and dangerous archetype in the corporate world. The empire builder's primary motivation is not to maximize per-share value for the owners. It is to increase the size and prestige of the company they run. Their ego is directly tied to the scale of the enterprise. They want more revenue, more employees, more factories, more global reach. Bigger is always better. The empire builder's preferred method of capital allocation is the large, headline-grabbing acquisition. They are constantly on the hunt for another company to buy, often paying exorbitant prices and taking on huge amounts of debt to do so. The infamous AOL-Time Warner merger is the poster child for this kind of value-destructive empire building. But what happens when the empire builder can't find a suitable acquisition? They are left with a pile of cash and an intense psychological need to do something big. Sitting on cash feels passive and boring, so they turn to the next best thing for projecting strength and action: the massive stock buyback. They will announce a $10 or $20 billion repurchase program with great fanfare. But their motivation is not valuation. They are not buying back stock because it is cheap. They are doing it as a substitute for the acquisition they couldn't make. It's a way to deploy capital, to make a splash, to signal to Wall Street that they are still in the game. This often leads to the worst of all worlds: buying back large amounts of stock at fair or overvalued prices, simply because management lacked the discipline or creativity to find a better use for the cash. The empire builder sees cash on the balance sheet as a tool to expand their domain. The master allocator sees cash as a precious, optional resource to be deployed only when an opportunity presents itself that will create more than $1 of value for every dollar invested. For the retail investor, identifying the empire builder is a critical survival skill. They are often charismatic and lauded in the press, but their focus on size over value will, in the long run, almost always lead to mediocre or disastrous results for shareholders. The direct financial connection here is the insidious trick of EPS manipulation. This is the mechanism by which managers can look like heroes while potentially harming their company. Let's walk through the math of this corporate finance sleight of hand. Imagine GrowthCo, a mature company. Its business is stable but not growing. It earns a steady $1 billion in net income every year. It has 1 billion shares outstanding. Its earnings per share is therefore a simple $1. The management team, led by an empire-building CEO, is frustrated. They want to show growth to Wall Street, but the core business is maxed out, so they turn to financial engineering. The company has $20 billion in cash on its balance sheet. The board authorizes a massive buyback. The stock is currently trading at $25 per share. They spend the entire $20 billion buying back their own stock. At $25 a share, they repurchase 800 million shares. These shares are retired. The company now has only 200 million shares outstanding. The next year, the business is exactly the same. It still earns $1 billion in net income. But what is the new EPS? It's $1 billion divided by 200 million shares. The EPS is now $5. On paper, this looks like a miracle. The company has grown its earnings per share by 400%. The CEO's bonus, which is tied to EPS growth, is massive. The stock analysts praise the amazing growth story. The stock price likely jumps. But what has actually happened to the business? It is now $20 billion poorer. That cash, which provided a buffer against recession and could have been used for innovation or a future opportunity, is gone. The business itself hasn't improved at all. It's the same no-growth enterprise it was before. The growth was a complete illusion, created by shrinking the denominator in the EPS calculation. A shareholder who understands this sees right through the trick. A shareholder who doesn't is easily fooled, buying into a story of phantom growth just as the company's financial strength has been significantly weakened. This is a critical piece of financial literacy. Learning to distinguish between real operational growth and artificial, financially engineered growth is a prerequisite for successful long-term stock picking. A company's decision to buy back its stock does not happen in a vacuum. It is one of several choices a management team has when deciding what to do with the cash the business generates. This brings us to our fourth pillar: understanding the superior alternatives, or the hierarchy of capital allocation. A truly great CEO thinks about deploying capital with a clear, rational pecking order of priorities. A value-destructive buyback is a double sin. Not only does it destroy capital directly, but it also represents a massive opportunity cost. That cash could have been used for something far more productive. The story of See's Candies, one of Buffett's earliest and most beloved acquisitions, is a masterclass in this concept. In 1972, Berkshire Hathaway bought See's Candies for $25 million. See's was a wonderful business. It had a strong brand, loyal customers, and what Buffett calls a moat, a durable competitive advantage. The business produced high profits and, crucially, it did not require much additional capital to grow. It gushed free cash flow every year. The question for Buffett and his partner Charlie Munger was what to do with all that cash See's was generating. A typical corporate manager might have taken the cash and tried to expand See's aggressively across the entire country, opening hundreds of new stores. This would have been a classic case of empire building. But Buffett and Munger were smarter than that. They recognized that the magic of See's was concentrated on the West Coast. Rapid, large-scale expansion might damage the brand and would likely produce much lower returns on investment. So they resisted the temptation to pour all the money back into the candy business. Instead, they treated the cash generated by See's as a fungible resource. They took the profits from the candy business in California and redeployed them into entirely different areas where they could earn much higher returns. They used the cash from See's to help buy stocks like the Washington Post or to acquire other wonderful businesses. This is the key insight. The first and best use of a company's cash is to reinvest it back into its own core business, but only if that reinvestment can generate high rates of return. If See's could have opened new stores that were just as profitable as its old ones, that would have been the best place for the money. But since it couldn't, the next best thing was to find a new investment outside the business that could generate high returns. A stock buyback or a dividend is far down the list of priorities. It is what a company should do with its cash only after it has exhausted all high-return opportunities to reinvest, either internally or through acquisition. See's Candies became a cash engine that funded the growth of the entire Berkshire Hathaway empire, a testament to the power of intelligently redeploying capital from a great business into an even better opportunity. The failure of most companies to follow this logical hierarchy can often be attributed to the availability heuristic. This is a mental shortcut, where we rely on immediate examples that come to mind when evaluating a topic or decision. The more available a solution is in our memory, the more we hear about it, the more familiar it is, the more likely we are to choose it. For a CEO and a board of directors with a pile of cash on the balance sheet, the most cognitively available options are dividends and stock buybacks. They are simple to execute. They are discussed constantly in the financial press. Investment bankers are always pitching them. They are the standard, off-the-shelf answers to the question, what should we do with our cash? The much harder, less available options require deep strategic thinking, operational creativity, and valuation discipline. Finding a new, high-return internal project might require months of research and development. Identifying and negotiating a smart, bolt-on acquisition at a reasonable price is incredibly difficult and time-consuming. Because these superior options are harder and less available, management teams often default to the easy answers. They don't conduct a rigorous search for the highest possible return on their capital. They just pick the most convenient option. This is especially true for mature companies in slow-growth industries. They may not have obvious internal projects that can generate high returns. But instead of doing the hard work of searching for creative alternatives or simply returning the cash to shareholders as a dividend if the stock is overpriced, they default to the buyback. It allows them to do something and signals action to the market, even if that action is suboptimal. The truly great capital allocator fights against the availability heuristic. They force themselves to consider the entire range of options, not just the most obvious ones. They live by a hierarchy of returns, always searching for the best possible use of the next dollar of profit, even if it's the harder, less conventional path. So what is this hierarchy? How can you, as an investor, use this framework to judge a company's decisions? Here is the blueprint, a decision tree we can call the capital allocation gauntlet. This is how the masters of corporate finance think, and you can use it to grade the companies in your portfolio. At the top of the gauntlet is question 1. Can we reinvest this dollar of cash back into our core business operations and earn a rate of return that is significantly higher than our cost of capital? This could be building a new factory, investing in R&D for a new product, or upgrading technology to become more efficient. If the answer is a clear yes, this is almost always the best use of capital. It strengthens the core business and compounds value internally. If the answer is no, or if the opportunities are limited, we proceed to question 2. Question 2, can we acquire another business, in whole or in part, at a sensible price that will generate a high rate of return on our investment? This is the path of acquisition. It is fraught with peril, as most acquisitions fail to create value. But if a management team has a proven track record of smart, disciplined acquisitions, this can be a powerful way to grow. If no such opportunities exist at reasonable prices, we move to question 3. Question 3. Is our company's stock currently trading at a significant discount to a conservative estimate of its intrinsic value? This is the litmus test we discussed earlier. If the answer is a resounding yes, then a stock buyback becomes a very attractive option. It is, in effect, a high-return, low-risk investment in a business the management knows better than any other. If the stock is not cheap, we proceed to question 4. Question 4. Do we have high-interest debt on our balance sheet? Paying down expensive debt is a guaranteed, risk-free return for the company. If a company has debt with an 8% interest rate, paying it off is like earning a guaranteed 8% on its cash. This is often a better use of capital than buying back fairly valued stock with a 6% earnings yield. If the debt levels are manageable and interest rates are low, we finally arrive at question 5. Question 5. If we have exhausted all of the above options, the last and final choice is to return the capital to the shareholders in the form of a dividend. A dividend allows the shareholders themselves to decide what to do with the cash. They can use it to invest in other opportunities, or they can spend it. It is the honest admission by management that they have no better use for the capital within the business. A company that follows this gauntlet with discipline is a capital allocation machine. A company that jumps straight to buybacks, question 3, without considering high-return projects, question 1, or when its stock is expensive, is signaling a failure of management. The antithesis of this disciplined process is embodied by the character of the unimaginative CFO. This is not a malicious actor, but a manager who is simply following the standard corporate playbook. The unimaginative CFO sees excess cash on the balance sheet not as an opportunity, but as a problem. It's inefficient. It drags down our return on equity. They feel immense pressure from institutional investors and analysts to, quote, optimize the balance sheet. Their toolkit is limited. They lack the operational vision to champion a game-changing internal investment. They lack the valuation courage to make a bold acquisition during a downturn when prices are cheap. Their world is one of spreadsheets and financial models, divorced from the messy reality of business operations. So what do? They call their investment banker. The banker, who earns fees from transactions, will almost invariably recommend a leveraged recapitalization or a large share repurchase program. It's the standard cookie-cutter solution. The unimaginative CFO then goes to the board and presents a plan to, for example, borrow $5 billion and use it, along with cash on hand, to buy back $10 billion of stock. The models show that this will instantly boost the company's EPS. It will increase the stock price, they argue. The board, also lacking imagination and wanting to see the stock go up, approves the plan. The company then executes this massive buyback, often at a time when the stock is fairly valued or even overvalued. They have successfully solved their cash problem, but they haven't created any real, long-term value. They have simply added leverage to the business and retired shares at a mediocre rate of return. The opportunity to use that $10 billion to truly transform the business, to invest for the next decade, has been squandered in favor of a short-term financial engineering trick. This is the path of mediocrity. It's what most large, mature companies do. It's not a path to ruin, necessarily, but it is a path that guarantees underwhelming long-term returns for shareholders. The direct financial connection here is the crucial metric of return on invested capital, or ROIC. This is arguably the single best measure of a company's financial performance. It tells you how much profit the company generates for every dollar of capital that has been invested in the business. A high ROIC means the company is a wonderful compounding machine. A low ROIC means it is a mediocre or poor business. Let's see how the capital allocation gauntlet impacts ROIC. Imagine a company has $100 million in cash. Option 1. It invests that cash in a new factory, an internal project, that will generate $20 million in new annual operating profit. The return on that invested capital is 20%. This is a fantastic result that will significantly increase the overall ROIC of the company and create immense long-term value. Option 2. It uses the $100 million to buy back its own stock, which is fairly valued and has an earnings yield of 7%. The return on this investment is 7%. This is a far cry from the 20% return of the new factory. The company has chosen a 7% return when a 20% return was available. This is a clear failure of capital allocation that will lead to slower growth in shareholder value. Option 3. It uses the $100 million to buy back its stock when it is very overvalued, with an earnings yield of only 3%. This is a disastrous decision. The company is deploying capital at a rate of return that is likely below the rate of inflation. It is actively destroying the compounding power of the business. By analyzing a company's decisions through the lens of ROIC, you can see the quantifiable impact of their capital allocation choices. A management team that consistently finds ways to deploy capital at high rates of return is a team you want to partner with for the long term. A team that defaults to low-return buybacks is a team that will, at best, deliver mediocre results. This is the financial engine of portfolio growth, hitching your wagon to businesses that are excellent compounders of capital. This brings us to our fifth and final pillar, the grand synthesis of everything we've discussed. How do you take this deep understanding of stock buybacks and capital allocation and use it as an ultimate signal for stock picking? The answer is that by analyzing a company's history of capital allocation, you can identify the truly masterful managers, the ones who think and act like owners. This is the secret to successful long-term investing, finding the right partners to compound your wealth. And there is no better case study in history than the aforementioned Henry Singleton of Teledyne. Singleton wasn't just good at capital allocation, he was a revolutionary. From 1966 to 1990, he built a massive, complex conglomerate. But his true genius was in how he managed the company's share count. In the late 1960s, during the go-go years, conglomerate stocks were Wall Street darlings. Teledyne's stock traded at a very high price-to-earnings multiple. Singleton astutely recognized that his stock was expensive, so he used it as a currency, issuing new shares to acquire over 130 different companies. He was trading his own richly priced paper for real, tangible businesses. Then, in the bear market of the early 1970s, the tables turned. Conglomerates fell out of favor. Teledyne's stock price crashed, falling to a tiny fraction of its intrinsic value. Singleton, seeing his own company as the best bargain in the market, completely reversed his strategy. Between 1972 and 1984, he executed 8 separate tender offers, using the company's cash flow and even taking on debt to buy back his own stock. In this period, he bought back over 90% of Teledyne's outstanding shares. Let that sink in. He eliminated 9 out of every 10 shares. For the shareholders who held on, like a small group of devoted followers, the results were astronomical. Their ownership stake in this collection of businesses grew tenfold, not because they invested more money, but because Singleton used the company's own capital to consolidate their ownership at bargain basement prices. An investment of $10,000 in Teledyne at the beginning of this period would have grown to well over $1 million. Singleton was the ultimate market timer, but not for the stock market as a whole. He was a master at timing his own stock, issuing it when it was praised by the market and repurchasing it when it was scorned. His career is the perfect embodiment of this entire thesis. He was the ultimate owner-operator, a manager whose every move was dictated by a rational calculation of price versus value, and his long-term shareholders were rewarded with fortunes. To find the next Henry Singleton, or at least to avoid the legions of value-destroying managers, we must actively fight against our own psychology. The primary biases that prevent us from making this kind of clear-eyed analysis are confirmation bias and the halo effect. Confirmation bias is our tendency to search for, interpret, and recall information in a way that confirms our pre-existing beliefs. Once we buy a stock, we want to believe we made a smart decision. We will subconsciously seek out news articles that praise the company and its CEO. We will dismiss negative information as noise. If the company announces a buyback, our confirmation bias will kick in and tell us, "See, this is a great company." Management is confident. We won't perform the critical analysis of valuation because it might lead to an uncomfortable conclusion that our chosen management team is making a mistake. The halo effect is the tendency for our impression of a person or company in one area to influence our opinion in another area. If a company has a well-known brand, like Apple or Disney, we tend to assume that everything it does is brilliant. The CEO is a visionary, the products are flawless, and therefore their capital allocation must be genius. This halo prevents us from looking at a buyback decision with the necessary skepticism. We assume that because the company is great, the buyback must be great, but even the best companies in the world can overpay for their own stock. Your job as an investor is to be a detective, not a fan. You must separate the quality of the business operations from the quality of the capital allocation. A great company run by a poor capital allocator can be a mediocre investment. A mediocre company run by a brilliant capital allocator can be a life-changing investment. Fighting these biases requires a conscious, deliberate effort to look at the facts, to check the numbers, and to question the narrative, especially for the companies you already own and love. This leads us to our final blueprint, the long-term partner test. This is the process you will use to screen potential investments and to continuously grade the companies in your portfolio. It is the culmination of our journey, the practical tool for stock picking that this knowledge enables. Step 1. the 10-year cash flow audit. Go to a financial data provider and pull up the last 10 years of cash flow statements for the company you are analyzing. Your task is to play accountant. For each year, see how much cash the company generated from its operations. Then, track where all that cash went. How much was spent on capital expenditures to maintain and grow the business? How much was spent on acquisitions? How much went to paying down debt? How much was paid out in dividends? And crucially, how much was spent on share repurchases? This will give you a decade-long map of the management's priorities. Step 2. Correlate buybacks with price. Now, open a 10-year stock chart for the same company. Place it side by side with your cash flow audit. Now you can answer the most important question. When did they spend the most on buybacks? Was it in the years when the stock price was low and beaten down? Or was it clustered in the years when the stock was at or near its peak? This simple visual correlation will tell you more about the financial acumen of the management team than any interview or press release ever could. You are looking for a clear counter-cyclical pattern, buying heavily at the lows and lightly or not at all at the highs. Step 3. The shareholder letter deep dive. Read the CEO's shareholder letter for each of those 10 years. Use the search function on your computer. Search for key phrases: capital allocation, intrinsic value, share repurchase, return on invested capital. Does the CEO discuss these topics with intellectual rigor? Do their stated principles align with their actual actions that you discovered in Step 2? A management team that talks intelligently about buying back stock only when it's cheap and then has a 10-year record of doing exactly that is a team you can trust. They are a potential long-term partner. Step 4. The final verdict. After completing this process, you will have a deep, fact-based understanding of the management's character and skill as a capital allocator. You can then make a judgment. Is this a team you are willing to entrust your capital to for the next decade? This process is the heart of due diligence. It takes work. It's what 99% of retail investors will never do, and that is why it provides such a powerful and durable edge. The antithesis of this disciplined analytical approach is the all-too-common story of the retail investor who falls in love with a story stock. This investor is captivated by a narrative, a revolutionary new technology, a charismatic visionary CEO, an industry that is going to change the world. Their investment is based on emotion and excitement, not on a cold calculation of value. The stock price soars, driven by this powerful narrative. The company, having raised money from the public, is flush with cash. The charismatic CEO, wanting to add fuel to the fire, announces a massive billion-dollar stock buyback. To the story stock investor, this is the ultimate validation. It is the final piece of evidence that the story is true. Wow, they think, the company believes in its future so much they are buying their own stock. They must know it's going much, much higher. They ignore the fact that the stock is trading at an insane valuation, perhaps 50 times revenue or 200 times earnings. The buyback short-circuits what little analytical process they had. They see it not as a financial transaction to be evaluated, but as a dramatic gesture of confidence. Buoyed by this news, they buy even more stock, piling in at the top. When the narrative eventually collides with reality, when the growth slows, the competition arrives, the technology disappoints, the stock price collapses. The $1 billion spent on the buyback at the peak is gone. The investor who was seduced by the story and the grand gesture of the buyback is left with catastrophic losses. Their mistake was analyzing the story instead of the capital allocation. They failed to ask the simple, boring, but wealth-preserving question, at what price? The ultimate financial connection, the reason this entire analysis is so critically important, is the long-term effect of compounding. The difference between a company run by a masterful allocator and one run by a mediocre one is not a few percentage points of return here and there. Over a long investment horizon, the difference is monumental. Let's imagine two companies, Accretive Inc. and Dilutive Corp. Both start at the same size, with the same growth rate in their underlying business operations. Both generate the same amount of free cash flow each year. The only difference is their capital allocation policy. The management of Accretive Inc. are disciples of Henry Singleton. They are patient. They hoard cash when their stock is fairly valued. But during market panics and recessions, when their stock falls to a 50% discount to its intrinsic value, they pounce, using all their accumulated cash to buy back shares at a massive discount. The management of Dilutive Corp, on the other hand, are unimaginative CFOs. They feel pressure to return capital every year. So year in and year out, they buy back a steady amount of stock, regardless of valuation. On average, they end up buying back stock at its fair value, and sometimes, during market peaks, they overpay. Now fast forward 20 years. The underlying businesses of both companies have grown at the exact same, respectable rate, but the returns to the shareholders will be vastly different. The shareholder of Accretive Inc. will have seen their ownership stake in the business dramatically increase over the years as wave after wave of cheap shares were retired. The per-share value of their holding will have compounded at a much faster rate than the business itself. The shareholder of Dilutive Corp will have seen their per-share value merely track the slow growth of the business. The steady buybacks at fair value did little to enhance their returns. The result? The stock of Accretive Inc. may be a 50-bagger, a life-changing investment. The stock of Dilutive Corp. might be a 5-bagger, a decent but unremarkable return. This is the hidden engine of portfolio growth. It is the secret that separates good investment outcomes from truly extraordinary ones. Your job is to find the Accretive Inc. S of the world and avoid the Dilutive Corp. Des Cecily. And the clearest signal they give you is how they handle the simple yet profound decision of the stock buyback. You have now acquired a powerful new lens through which to view the world of investing. You will never again hear the words share repurchase program and react with mindless applause. You no longer see a buyback as just a headline. You see it as a litmus test for managerial competence, a window into the mind of the CEO, a signal that separates the true wealth builders from the financial engineers. You now possess the framework to distinguish a value-accretive transaction that makes you richer from a value-destructive one that secretly steals from your pocket. This is a profound and permanent upgrade to your financial literacy. But this test, this mastery of capital allocation, is just one crucial pillar in the grand architecture of enduring wealth. Warren Buffett did not just become the world's greatest investor by skillfully evaluating how other managers allocate capital. He built his entire empire, Berkshire Hathaway, on a specific and unique corporate structure that weaponizes this very principle on a scale the world has never before seen. Understanding how a manager allocates capital is step one. Understanding the corporate vehicle that provides the optimal fuel for that allocation is the next level. The video on your screen right now is the missing link. It is the next piece of the map. It explains the structural advantage, the financial plumbing of Berkshire Hathaway, that allows Buffett to take the cash from a candy company in California and seamlessly deploy it into an insurance operation in Omaha or a railroad in Texas, all with maximum efficiency and intelligence. It is the bridge between knowing the rule and owning the entire system. Most people will stop here, satisfied with this one powerful tool. They have learned a valuable lesson and will be better investors for it. But for those few who are not just interested in better stock picking but are on a serious quest to build a true fortress of financial freedom, for those who want to understand the machine, not just its components, the next step is non-negotiable. The choice is yours. Click the video and complete the blueprint. Continue your ascent.